Hello, active traders, and welcome to How to Trade Winning Breakouts and Pivots with myself, Ken Calhoun, and my longtime colleague, Steve Nison from CandleCharts.com. It's a real honor to have so many of you here. Really excited with what you're about to learn tonight. We've got over 1,170 of you registered for tonight, so a really big turnout. And Steve Nison, I just wanted to welcome you to tonight's event as well. Steve will be going second, I'll be going first, and then we'll wrap up together at the end.
Yeah, Ken, thanks. Look forward to doing this special presentation with you.
All right, well, as always, all information is for educational use only, not making advice about what to buy, sell, or hold. Tonight's goals is really to help improve your ability with very quick patterns for how to make bigger winning trades more often and do it on your terms in a way that makes sense for you. And really want to show you how you can combine candles with professional high volatility breakout entry and exit signals. I've been working with Steve for nearly 15 years now. It doesn't seem like just yesterday. It doesn't seem like it's been 15 years, but real pleased to work with Steve because he's the world's foremost authority in candlesticks, the only person you should be learning from for that, and I'm the go-to guy for breakout, swing, and day trade. So for those of you not familiar with me, it's hard to imagine at this point in my career, but you may have seen me a couple weeks ago as one of the top speakers at the Traders Expo in New York. I've been promoted to paid status, had almost 200 people there. Be sure to take a second look at my article in Stocks and Commodities from November 2014. I've been an active trader. I do Vegas seminars and have a lot of fun. Traders cheer out loud, and it's great to see. Let's start off with the money, okay? Enough of that. Let's look at charts and money. I want to start off by giving you my most valuable technique first. My long-time saying is that the math, the numbers, the P&L is much more important than chart patterns. And this is what I mean by that. This is kind of $600 the hard way, but you need to figure out as a trader how to be right only 30% of the time and still walk out of Wall Street with some money in your pocket. So the key is real small stops and even modest wins when you're right that all adds up to making money for you. So one of your challenges as a trader in training is to figure out how to still make money without being right over half the time. And whenever I survey my audiences or ask people at the expos or whatnot, still only 10 or 20% of the people self-report that they are using any kind of scaling in or position sizing. You need to change that. That's the only way to make money in this market. You have my word on that. I've traded millions of dollars worth of stocks, ETFs, minis, and Forex. I know how to trade. You got to use really tight stops, throw a lot of darts at the market, and take money out of the ones that work out. Or you may be that's kind of a high velocity day trading day. Here's a more leisurely swing trading day. I was doing a couple thousand shares of MGM and this is my best trade in recent years, $3,700 in a single day. So let's take a look at our charts. Kind of that's it for the PowerPoints for now. I want you to learn these strategies with me tonight, and we're going to go through some very good charts. I'm not going to read all these off. Let's just jump into the charts and look at what I'm talking about. With an S&P, this is our S&P index on a 15-day chart basis. You can't make money trading the indices alone. You need to trade instruments that have much superior chart patterns. And we're going to be looking at some very specific strategies right now that you can use to help leverage that. One of my favorite visual patterns, I'm a price action swing trader and day trader. One of the things you want to look for is what I call an acceleration ramp. And this is where you have a steady uptrend that then goes to, say, a 45-degree uptrend during the last 3 to 5 days. That tells you got institutional volume and a new breakout in progress. You don't need to use MACD crossovers, RSI, stochastics, B-bands. All that stuff can help, but it's more important to be trading the right high-velocity instruments in the first place, which leads me to my first major concept of the night, and that's what I call two-day in versus out trading. On the street, they call out days in which the S&P and the broad markets and the NASDAQ are outside of the previous day's high-low. Proof of concept. Go back over your last 20, 30 trades and look at the stops versus wins. I can pretty much guarantee most of your wins are going to be ones that were initiated when the price of that instrument was above the previous day's high for a long or below the previous day's low for a short. So if you want to avoid false breakouts, and I've tested this out with tens of thousands of real money trades over the years, do not trade things that occur or originate inside the previous day's high-low. If you just wave that magic wand across most of your trading, you'll do much better. And that's a very good, effective professional strategy. Gaps continue most of the time, like today's CarMax. Another good example, two-day high. Don't fool around with anything that's opening inside the previous day's range. Instead, only trade things that are outside, exclusively outside of the previous day's high-low range. You have my word. That's absolutely correct Ask any market maker, professional trader, they'll say there's a little more to it than that, but that's a quick thing. Wait until it's above previous day's high or low. So that's 2-day in versus out trading. Don't trade things that are chopping around inside previous day's ranges like this one, Electronic Arts, because it doesn't do anything. It's not going to go anywhere. Like running into a wall of resistance at the 50% mid-range. If you want to make money as a trader, which we all do, your goal is to make as much money as you can as quickly as possible, right? My goal is to help you get there as quickly as you can with minimum stop losses along the way. How about wide range candles and cup patterns? One of the things that I like to look at on a daily chart is this specific pattern, and you can see more in my November Stocks and Commodities magazine article. One of the very easiest things you can do as a professional trader, and when Steve comes up in about 15 minutes, maybe he can add to this, but one of the things that I always look for, you can see a couple of hammers or hammer right there, which is a good reversal. I kind of wait for things to take out new highs. One of the single best strategies you can use as either a candlestick or a Western technical professional breakout trader is to wait until after you've got a wide range candle as defined by a candle whose height is at least twice the whole real body of the average height of the previous candles. That often leads to good things, right, as we take out new highs. To set up an entry strategy, I will usually, in my own accounts, in my Fidelity SEP and my IB account, I'll use 50 cents or so above the high of that candle. So I get out of any false breakout or uncertainty, and I get in on a technical breakout that's well in progress. It's likely to keep running on up. In this case, 6 points for me, this one ran. So this is the pattern, a wide range candle at the right side of a cup. If you're a pivot trader, you can get in, say 50. I use 50 cents for my stock swing trades, 50 cents above the high of a hammer. But I don't trade pivots. I'm a breakout trader, so I will wait. I wait until I've got a lot of volume and volatility. If you want to put one effective strategy in front of your trades, just simply wait for these type of patterns to emerge. It's very visual and it's very easy. You have my word, it works extremely well. Test it out for yourself. Just look for a big, wide, tall candle at the right side of a congestion box or a bullish cup. And Steve always reminds me to remind you guys what a cup is. It looks like the letter U. And by the way, Steve's a foremost expert in Western technicals too, not just candlesticks. He knows more about Western technicals than most of the universe too, so he's a brilliant guy in that too. Anyway, bullish cup looks like the letter U or a triangle or whatever. A wide range candle. And if I had more time, I would do an audience interaction, or if I was doing a live money show event, I would say, where would your long trigger be? Turn to the trader next to you and discuss it. I'll give it away. It's just 50 cents above that, so that puts you in at, say, 32.50. To scale in, I use every 2 points. For my initial stops, because I always get this question, and it's an important one, I use no more than 2 points for stock swing trades. Now, I will only trade instruments priced between $20 and $70 a share. Most of them are 30 to 50. Most of my trades are 30 to 50 a share. A little higher with the rally market we've had lately, but you don't want to trade junky under $20 crap charts that don't move anywhere. You don't want to trade bad leveraged Tesla, Amazon, Netflix, Priceline type of instruments, or Apple, or so forth. You want these kind of instruments that have potential to run 8 or 10 points in your favor. On the inverse side of that, even though I don't see a bearish engulfing and I don't see a shooting star, one of the things that causes me caution is when I see after a ladder, and these are rider downers, as a marketing fellow Dan would tell you, these are rider downers. You see a stair-step ladder of multiple large, wide candles that then goes to smaller whole real body candles. That's a good time not to sell right now. This is still an uptrend continuation, but tighten in a trailing stop. And personally on a swing, I would use right under this candle support at 39.50. So wide range candles, yes, that gets us into momentum, but then we tighten in a trailing stop to get out. Now let's take a look at another strategy. I've got a lot, and I've only got 10 minutes left. ADX over 40. This is very simple. And in standard chart properties, I decolor the plus and minus DI lines intentionally because I only want the red signal line. The strategy is just to look for a red ADX signal, and that one does it too, but let me give you another one. Halliburton, here it pops up, it breaks over or pierces the 40. The strategy is to go in long at 50, and the odds are you're not going to see this until that night, so it's kind of late to be getting in that day. That's okay. You still have plenty of room to run. you set a long trigger. I'll use a buy stop order 50 cents or so above the high of the day in which it generates an ADX over 40. Kind of like Jaws. It comes from below. Da-dun, da-dun, da-dun. Wow, it's eating the, okay, it's coming up, breaks over the 40. That's a good volatility indication. The ADX, Wilder's average directional index, is a good momentum indicator, kind of like a volume control on a stereo or the gas pedal on a car. When you see the ADX start to spike, that kind of just a good discipline tool. It tells you, yes, this thing is in motion and it's worth trading at new highs. So that's Halliburton. Another one here is WMB. By the way, how much money could you make if you trade these kind of charts, right? Just do the math. Anyway, ADX came from below, broke over 40, and odds are we all missed it here. You just draw a horizontal resistance over there and get in at 50 cents above the high, which would put us in at 49.30, and we're off to the races. So look for an ADX breakout over 40, and then go in long on 50 cents above the high of the day in which it did that. It may occur up to a week or so later, so it gives you plenty of time to look for good entries. Next strategy, gap continuations, my number one play. I'm one of the industry's foremost experts in gap trading, and this is why it works most of the time. What you want to look for are minor gap continuations that you buy into, either for a day or a swing trade, also known as a window in candlestick parlance. And you can see these minor gaps usually attract new buyers. Sometimes you'll get a gap fade, but usually minor gaps, as defined by less than 10% of the price. So I don't buy a $17 stock that gaps up to $23, $24, but if it gaps a point or so, up to 2 points, it's worth my money, and I'll get in on that. And you can see this is another example, ADX over 40. Mark my words, follow this one during the upcoming week ahead. Long trigger would be, again, not a trade recommendation, but long trigger would be what? Say 20.6, right? 50 cents above the high of day today, which is 2010. So anyway, that's an ADX signal plus a minor gap continuation. Let's look at a couple of other charts here. It's very simple once you know how to trade, but the trick is you have to only trade the very best, finest, highest volatility instruments and combine that with what Steve teaches you at candlestick charts with momentum breakouts to be able to get the best of both worlds. Either you enter on pivots and then enter on continuation breakouts, or you scale in and then use the pivot signals, like here's a bullish engulfing off the low, right, which is a good pivot signal, or you want to wait for a new high breakout over 32. Either way, it's a good gap continuation. This is in play. Wall Street professional traders always call things, are they in play or not? Is it worth trading or not? In other words, is there volume and volatility or not? Here's another good one, QUNR. Here's the perfect minor gap continuation. This thing only gapped around 50 cents, and then even if you missed the first day, when it ran from 29 to 32, you could have got in the next day at 33, or the next day, or the next day, or the next day, and so forth and so on. And this has a nice 15-point run. So minor gaps are usually, I like to look at them as kind of like a jump start. You know, back in the old days when we had to get our cars jump started, and because I stall out at the side of the road, this is a jump start with a minor gap that continues up. So it usually attracts institutional volume and buyers. Okay. How about scaling in? One of the strategies that I've only got 5 minutes left, and I'm perfectly on time, by the way, master of timing. One of the things you want to look at, let me put up a chart with some volume instead of the ADX. I'm just always used to seeing volume at the bottom of my charts. Range Resources, RRC. The trick in scaling is you need to find charts that travel in a channel with some regularity or some consistency, right? Or like the CAG chart, right? This CarMax chart that's been running up and then gapped up, it got so excited and kept running on up, right? You need to trade high velocity charts that you can scale into without, you know, and the trick is, I have traded tens of thousands of dollars in single trades. Scaling, one of the things you need to do is avoid charts that are choppy and have large pullbacks, because you'll get nervous and close out the trade and not capitalize on it. My single best favorite chart in the entire known universe is Disney, because the Magic Kingdom is alive and well, and this is 3 years of Disney growth from 50 to 110. If you're a position or long-term trading, how much could you have made as you traded this thing and scaled in every few points, just socked away some more, even got a hammer off the moving average? That's one of my favorite pivot patterns. Kept running on up. Here's my favorite momentum velocity pattern to illustrate the validity of my approach. you see a nice wide range candle at the right side of a congestion or bullish cup pattern, and then it kept running on up another 8 points. So anyway, scaling in over time, whether using a longer term chart or a shorter term chart, is one of the more effective strategies, at least for professional trading, to try and sock away more money in your trading account. One other pattern to look for, and this is just a basic one I thought I'd throw out there, is always be on the lookout for cups. And I teach how to do that in an educational resource that we're going to talk about later, and all the rest of these. This is just kind of a very quick run through of some of my very favorite patterns, kind of a cliff notes for the very best of the breakout patterns. And you have my word that these work. You know, it's Steve and my goal to help you guys make as much money as you can trading. It's kind of a team effort, because if we can do that, then you're likely to stay with us for a lot of years, which many of you have been with us for 10, 12, 15 years, and we certainly appreciate the loyalty. For you to stay with us, we want to teach you strategies that actually have the potential to work out in real money trades and show you how to get in on the very best charts that don't have false breakouts. Now, one of the things about cup breakouts, a real simple rule of thumb for swing trades, is add 50 cents to the previous high before you scale in, because oftentimes if you just do simple, what I call naked cup breakouts, you'd have gotten stopped out multiple times here, right? I've got just about 4 minutes left, and I'll turn it over to Steve. But if you'd gotten in the first sign, and we've all done this, I've made so many failed trades. I've made hundreds of I've made actually thousands of bad trades and even more good trades, but one of the things that I learned is you got to avoid the false breakouts. Breakout versus fake out. So you got to put what I call a false breakout filter, or an entry trigger that's slightly above the obvious dumb public money, easy to spot resistance trigger. And you can raise your hand if you've been there. We've all done it. Hey, it looks like it was going up. I bought it. Oh, darn, took a stop. Tried it again. Oh, darn, took a stop. And then, well, forget it. I'm not doing well with this thing. And then it runs up 10 points without you. And then you get really frustrated and you tell the wife about it. If you've ever concealed trading losses from a spouse, you may have a problem. You may be learning the wrong strategies. You may not be learning professional strategies from real traders. So make sure that you're learning from world experts, guys like me and Steve actually know what we're talking about. Anyway, here's a good example of a cup breakout. Here's the congestion box. What would have happened if you had bought, this was a gap up and fade, but let's say you bought the first sign of a breakout. Would have worked out fine, but I would rather, and this is good, honest advice, what I would tell family and friends and colleagues, I would rather see you wait just a bit for entries 50 cents or so above the high. So here, where would your entry trigger be? Say 38.50, not 38.10, because we expect that we're very suspicious and expect it's going to try and screw us. As soon as we put on the trade, so the trading gods are against us. We just say no, and it goes down against us and we take a stop. But it looks so good at the time. Well, stop that. You want to trade stronger instruments and use false breakout filters as part of the strategy. Another thing that I won't have a lot of time to get into tonight, but you really need to get savvy on, and all professional traders know this, is be able to look for relative strength plays in the sectors when they occur. Now, I didn't spend much time on that tonight because all the sectors are, it's very much a cherry-picking market right now. The sectors are relatively quiet. Insurance has been strong. Earlier this past year, biotechs and pharmaceuticals have been strong. But lately, we've had relatively choppy markets across the board. So from a sector standpoint, you really need to, instead of looking at sector charts, look at the very strongest of the isolated breakout charts. And this is always dynamic. There's always new strategies for entries and exits. And as you're looking at your charts and you're trying to figure out, hey, let's say if I'm in a day trade, how do I know when to get out? Who can tell me the one candle that just pops out? And I swear, I've never looked at the 5-minute chart of this until just now. I do all my training on the fly. I'm a real trader. I work off my workstation. Where's the exit signal on along here? Where did it occur? Who can tell me? Yeah, Mira got it right. And DT. So it stands, some of my familiar traders here. Yeah, we have a shooting star right about there. And one thing that I like learning about from Steve, which I will turn over to momentarily here, is that Steve not only teaches you the patterns, but he teaches you the trading strategies. Whenever I look at what I call, I'm a fiercely loyal advocate of Steve Nison because I see all these copycat, I call them candlestick copycats out there. Invariably, when I watch their education, they always screw up. There's always a fatal mistake in terms of how to make a trading decision because they don't have the expertise that Steve Nison has. So make sure you learn from Steve how to use candles correctly and don't screw up. I've seen even in famous magazine articles, I can spot candle errors. They pop right out. And I only know about maybe 5% of what Steve Nison knows. He's the expert in candles. I'm the expert in breakouts, and I'm wise enough to know the difference. So, but anyway, that's shooting star. And the exit signal would be, say, I use 10 to 20 cents under support to get out. Now, it wouldn't have harmed me if I'd stayed long on it. It just kind of didn't do much later in the day, but that's the loss of support of that shooting star gets you out, say, on a day trade, and you use a 5-minute chart. And they work extremely well. And you see a 2-day high cut breakout. Good example of east and west, which is our theme here tonight. I like 2-day high breakouts, and I use the candles to get me out of trades at the first sign of trouble, and that's a perfect example for either a day or a swing trade. So really good chart examples with that. Well, with that, let me turn it over to my esteemed colleague, Steve Nison. Let me introduce Steve first, give him a proper introduction as every professional speaker deserves. Steve Nison, a certified market technician, holds the distinction of introducing Japanese candle charts to the Western world, regarded as one of the foremost technical analysts in the world, and he is. Steve's stuff actually works most of the time, so he's another good guy. He's not only the acknowledged master of these candlestick techniques, but also an expert in Western technical analysis with over 30 years, 3 decades of real-world experience. He's been featured in Wall Street Journal, Barron's, CNBC, a lot of different places, and he's presented his trading strategies to thousands, actually now tens of thousands of traders worldwide on how to apply and profit from these professional methods with this training. So without further ado, let's turn it over for Mr. Steve Nison. Hey, Steve, welcome.
Hi, Ken. Thanks. Great. Thanks for the introduction. And why don't we just go right to the next slide? And, obviously, Ken is the expert on intraday trading, but what's great about the candlesticks is that you could also use some strategies for intraday trading. And this is actually one of the slides. Ken will be talking about our major resource, and this is one of the slides on that resource. And I go through each of these in detail, but what I'd like to do now is just focus on, one of these aspects. Candles intraday will give you early reversal signals. You can find hidden support and resistance. Is the market really overextended? It may look overextended on a daily chart, but on an intraday chart, it's really not. And the goal is using you can use daily charts for your intraday trading. But let's just look at one of these now. What we're going to do is look at how we can find hidden, or actually early reversal signals. So here on this daily chart, and it doesn't matter if you trade equities or ETFs, same concept. So here on the daily chart, we have a hammer, and Ken pointed out the hammer on one of his slides a couple of minutes ago, one of his markets. Essentially a candlestick with a very long lower shadow and white or black real body. And here we got the hammer confirmed at a little above $53. Remember, for a candlestick signal, you need open, high, low, and close. So it's really not a confirmed candlestick signal until the close. So here on the close of the daily chart, we got a reversal. Nice rally, but we had to wait all the way for $53. Now, on the same day, by using an intraday chart, this happens to be a 60-minute, we also had a hammer. In this case, it's a black real body. Remember, the hammer could be a black or white real body. But, we'd still have to wait for the close, but we don't have to wait for the close of the daily session. We waited for a close of a intraday session. So here, we got a reversal signal $4 earlier than we would have with by waiting for the daily chart. They both worked out fine, but you've essentially, by buying at $49, assuming it's a good risk reward, and you set a protective stop judiciously, we made an extra, we bought $4 earlier than it would have been if we waited for the close of the daily chart. Now let's look at an example of how we could use intraday to get early reversal signals. So here on this daily chart, we see the market on April 15th, and it closed right around $83. And we ask ourselves, where is our first support area? And I think most of us would recognize probably $78. Look how many times it was tested. And in fact, there's a piercing pattern right there, with that white candle getting people into the black real body. But even if there wasn't a reversal candlestick signal, it's a multi-tested support. But for most of us, with the market near 83 and having support at $78, that doesn't do much good if we're looking to buy it. we want a protective closest stop. So what I'll do for my own trading, when I do have the ability to look at intraday, unfortunately, because I'm running a company, most of my trade setups are based on the daily chart, and from time to time I'll look at intraday, and when I do, and Ken is the expert on intraday, but the few times I am able to look at intraday throughout my busy schedule, if I see something like this, I'll go to an intraday chart. So let's look at an intraday chart on April 15th, where that tall white candle is. Now this is an intraday chart, and here we see April 15th. That's the trading on an intraday on April 15th, and notice right around the $82 level. Notice, back at around 1:30 or 2 o'clock, how many times that was tested. And I believe this was a 30-minute chart, if I remember correctly. And I normally don't go less than 15 minutes on this. So for time after time after time on an intraday, we see there's a nice support area, a little bit of a hammer, actually, to the right. Actually, there we go, a hammer to the right, confirming a support level. But here again, we have 4 or 5 sessions confirming support at 82. So what I would then do is say, okay, although the daily chart shows first support at 78, and that to me is major support. There are different levels and importance of support. The $78 support area previously shown on the other chart, the prior chart, is major support. But now I have S1, that's what I call my first support, at $82. How do I get that? By looking at the intraday. So let's look at what happened on the next slide, right around 82, and that's at support area. So if we can advance it to the next slide and hit the advance key again. There we go. And that support zone was obtained by the intraday chart. And there was no way we could have gotten that support based on the daily chart. So once again, an example of the early reversal signals. As good as candlesticks are for giving you reversals, they are even better when you use them on an intraday perspective. And that's why I teamed up with Ken to combine intraday candles with his favorite intraday and swing trading techniques. And let's look at the next slide, where we look at another example of hidden support or reversal signals. So here we have really no bullish candlestick signals near the lows here, right around on Netflix, and this was a little while ago, around $325, $300 area. There was a hammer, right, keep going to the right, there was a hammer there, right, over there. But what was interesting is, yes, this hammer confirmed a support level, but if we look on the intraday chart to the right, notice how we got back-to-back candlestick signals. The first, the blue arrow, shows a piercing pattern, and at the red arrow we had a bullish hotomy. So what that does is it really gives you an extra level of confidence. So on the daily chart and the blue arrow on the left side, there's no bomb reversal signal. We did get a hammer a couple of days later, but if you want to determine how much of a position you want to put on, because it's not only a matter of knowing when to do the trade and where to set the stop, but how aggressive you should be on your position. So here on the daily chart, we had the hammer confirming a support area, and then on the intraday we also got reversal signals. So with this, I'd be quite comfortable doing a full position, 100% position, on any outright trade you were thinking about doing that, and of course always have a protective stop. Now, one of the things I also do in our resource is have a trading checklist. And as shown on the next slide, these are some of the key factors for the trading checklist. And obviously, we don't have time to go through all of these in this short webcast, but what I'll do now is just show you a couple of ideas on how you could use finding key support and resistance and a convergence of clues. So, finding key support and resistance. Right? So here we see all you need to do is ask 2 simple questions to find key support or resistance. This is one of my favorite strategies, by the way. Is the market at support or resistance? So, I personally like horizontal support and resistance. I keep it real simple. And then the next question is, are there any reversal candles? So let's look at the next slide. So here we have two scenarios. Now the market is at resistance in both of them. But which one is more likely to have a sell-off? If we have a group of candlestick signals like scenario 1, where each session, and this could be intraday or daily, it doesn't matter, where each session essentially closes at its high or close to its high. Or is it more likely for the market to sell off in scenario 2, where each time it gets to resistance, the bulls are able to, the bears, I should say, are able to drag the market low, into the close, or almost at the low price of the session. So even though the second candle in scenario 2 is a white real body, notice that long upper shadow, and what is that showing us? The market's rejecting higher levels. So the answer to this is I would be much more nervous, or I'd be much more confident, put it that way, on a bearish trade in scenario 2. Now, looking at scenario 1, one of the strategies Ken talked about earlier in the session is, thinking about trading on a breakout. And that's a great way to trade, a momentum trade, going in the direction of the breakout, whether the breakout's to the upside or downside. So what I would be doing in scenario 1 is, I wouldn't, although the market's stalling at resistance, I might put that stock or ETF on a watch list and get an alert if the market breaks above the resistance area, because by chipping away at the resistance there, each day is closed right near resistance. That to me is a higher probability of a breakout than it would be in scenario 2. And like Ken said, one of the best ways to trade a breakout is with a tall white real body breaking out. And actually you could also add volume to that. You may want to see a high volume wide range white real body. So let's look at using this idea of support and resistance and looking at the candle line at support and resistance. So here the market's ascending, and during the rally the bulls are in control. But as shown here, let's hit the advance please, if we can do that. Okay, what's that small candle line, that real body hinting? Right, the market is stalling near a resistance area right around the 1680 area. So I call this the Candlestick Screener, because you're using the candlesticks to screen for how solid support or resistance is. So on that small real body, and then the next day you had a black real body wrapping around that white real body, which is the bearish engulfing pattern, that'd be a great trading opportunity for a bear trade. And likewise, if you want to trade breakouts, I would wait for the market to break above that resistance area. Okay, if we go to the next slide. And that's that resistance I was talking about. Great, thanks. And we'll go to the next slide. Thanks. So here we have, again, using the early reversal signals of candles. So, we got a hammer on the daily chart, and, reversal signal right around 710. This is on Google a little while ago. And notice on the 30-minute chart, we also got a reversal signal, but as we saw before in another example, we got an earlier reversal signal. So we got it right around 697 instead of the $710 area. So $13 earlier per share. So if we go to the next slide, these are just some examples of those intraday reversals. So here we all remember the high in Apple. A few years ago when it got to 700. This is pre-split, and we actually got a bunch of candle reversal signals. I'm not going to go into them on the daily chart, but the point is the earliest reversal in Apple was on the intraday, where we had back-to-back bearish engulfing patterns. And I wouldn't say short based on that. This is an intraday chart, but one of the great things you learn in Ken and my education, our joint education, is the ability to use these signals to lock in profits. It's when we're thinking about buying or putting on a new trade, initiating a new trade, whether it's a long trade or short trade, we're really in control, right? We know we could decide when to pull a trigger or not to pull a trigger. But once we have a trade on, we're more reactive rather than proactive. When you're initiating the trade, you're proactive, but when you're in the trade, you're reactive because the market is now pulling the strings. So you have to be very nimble, very quick, and know how to use the education to know when to start locking in profits. And this is just a great example of that with Apple. So let's go to the next slide. Okay, so here, get on Amazon, okay, on the daily chart, in this area here, no real reversal signals. And let's go to the intraday chart. So here we had a series of bullish engulfing patterns. The first two blue arrows are actually little bullish engulfing patterns where the green candle wraps around the black real body. The second one is another bullish engulfing pattern, and the third one is hammer. I mean, you didn't have to be, I guess I mean the pun here, you didn't have to be hammered over the head to realize this is a great buying opportunity. Again, always having a protective stop. You know, no matter how good something looks, there's always a price that says you're wrong. But this was a great trade setup. We had 3 separate candle signals right at the support area. Now let's look at, I had mentioned about the importance of protecting your assets, stops, and so forth. So here we're going to be looking at protecting your assets. So if we can advance it, or protecting your butt. And this is probably one of the most important things that you could do for your trading. Protect your assets. You know, risk control is key. Ken had mentioned, I think he had said 70%, or am I right? 70% of the trades may work against you, and 30%. When I was doing trading and when I was doing trade recommendations, that's what I used to do at the brokerage firms. We all had our P&L, and I had the best P&L, and I had more losers than winners. But the reason for the good profit and loss is because, you know, the old saying, cut your losses. It's very easy to say, it's very emotionally hard to do, but that is so true. You know, so I would not expect, as Ken said, you know, don't expect to have more winners than losers, or even 50-50. Expect to have more losers than winners, but the idea, let those profits run, and what that means is knowing when to exit and cut your losses short. That means protecting, you know, your assets, setting protective stops. So let's look at the next slide. Okay, so here, all right, if this was a bar chart, this market would look healthy. It broke above a resistance area, but as much as Ken likes breakouts and tall white candles, think about what that means. If the market breaks out on a doji or a small real body like here, you know, that is showing us the bulls don't have the momentum to keep the rally going. Now, I wouldn't be selling short here, but at a minimum, I would know not to go long. And what's one of the best ways to make money? Not to lose money. So avoiding bad trades is a valuable benefit, a key benefit to, obviously, to protect your assets, to protect your trading portfolio. Now, one of the challenges most of us have is because in stocks we don't really sell short. It's a little harder to sell short in stocks than it is maybe in Forex and some other markets. But what one can think about doing is using inverse ETFs. So if we go to the next slide. So what's nice about that is that if you're bearish on a particular sector or some sort of market, you know, or whatever it is, you know, you could use an ETF. And what that means is if you're bearish, you could buy an inverse ETF, because as the market goes down, the inverse ETF will increase in price. So you're essentially going along the ETF, but you're going bearish the underlying market. So if we can advance this. So here, back in March, okay, as the dogs are the inverse ETF for the Dow. So as the Dow sold off last March, the ETFs rallied. So if you were bearish on the Dow, either technically or fundamentally, then you could use the candlestick signals to confirm your bearish outlook. So notice how we had a bullish engulfing pattern, the green wrapping around the black. And what's really important is when a candlestick signal confirms a Western signal. Remember the two questions you need to ask. Is the market at support or resistance? And second question is, are there any candle signals confirming the support or resistance? So here we had a classic bullish engulfing pattern confirming a support level. And this is what happened after. So with that, I'll turn it over to you, Ken.
All right. Well, thanks so much. Very good analysis. Always good to learn how to harness the best of both of our methods for identifying both swing and intraday entries and exits in our current market.